Before we dive in, just a quick disclaimer, I am not a financial advisor. This video is for informational and entertainment purposes only and is not financial advice. Always do your own research and never invest in anything based solely on what you see on the internet. Now let's get into it. So guys, in this video, I'm going to be answering some of the really great investing questions that I've been getting from all of you lately. Starting with this one here from my friend Jake, who wants to know if you had to restart your investing journey and could only own 3 individual stocks for the rest of your life, which would they be? So in this hypothetical example, I'll assume that I'm not allowed to sell any of these stocks since I'm basically taking them to the grave with me. And with that in mind, my approach when thinking about these different companies is to think about what's not going to change throughout the course of my lifetime. What's going to stay the same? And based on that, my first pick would have to be Procter & Gamble. I don't see any reality where people stop using things like toothpaste, deodorant, laundry detergent, shampoo, toilet paper, paper towels, and diapers. This one's especially true in my recent experience as a new parent. These are everyday items that people will always need no matter what's going on in the world, no matter what's going on in the economy. And Procter & Gamble owns some of the most trusted brands in all of these various categories. So I think it's a must-have for my lifelong portfolio. And if we look at my portfolio over here using Snowball Analytics, which you can start using right now for free, there is a link to try out Snowball Analytics in the description of the video. You should definitely check it out. This is hands down my favorite portfolio tracker. But anyway, as we can see, I actually already own Procter & Gamble in my portfolio. I have almost 48 shares at an average cost of $144.35. And right now, Procter & Gamble makes up about 6% of my portfolio, so it is well within the top 10 largest positions that I own. Anyway, guys, similar to what I was saying about Procter & Gamble, I also don't see a world where we will completely eliminate fossil fuels. I think we're always going to need them, especially, here in my lifetime at least. And because of that, my second pick would have to be Chevron. I actually think people underestimate just how many things rely on fossil fuels. Forget about gas for our cars or heat for our homes. Many people aren't aware that 99% of all plastics are made from fossil fuels. They are everywhere, and I don't see that changing anytime soon, which is why Chevron would also be on my list. And jumping back over to my portfolio, I also have this one too. I have 31, almost 32 shares of Chevron, and this position's done really well for me. I'm up 27.5% including dividends, and it is a bit of a smaller position compared to Procter & Gamble. It only makes up about 4% of the total portfolio. Anyway, now moving on to the third stock. This is the only one out of the bunch that I don't already own, and this one is actually going to be Walmart. Unsurprisingly, people will always need groceries, and Walmart is known as the place to get them the cheapest. And one thing about human nature is that people will always want to pay the least amount possible for whatever they're buying. This has been true since the dawn of time. It's still true today, and it will still continue to be true long, long after I'm gone, which is why I think Walmart is a great forever hold. But anyway, those would be my 3 picks, and it's really hard to narrow this down to just 3 because I do think there are so many great choices out there. But I want to hear from you. If you could only own 3 stocks for the rest of your life and you could never ever sell them, which ones would they be? Let me know in the comments below. Now jumping over to question number 2, this one comes from Shane, and Shane wants to know, can you have a successful portfolio with just dividend growth stocks, or do you need high yield to feed into it a little bit? Yeah, good question. So for starters, while any company that raises its dividend is technically a dividend growth stock, I personally think of dividend growth stocks as companies with lower starting yields, usually somewhere in the 1 to 3% range, that are also growing their dividends at a pretty high rate. Usually around 8% a year or more is the threshold that I consider to be, high growth. And you can think of companies like Visa, Snap-on, and Domino's Pizza. These are all great examples of dividend growth stocks. They definitely fit that criteria. And using that distinction, I absolutely think you can build a successful portfolio with just dividend growth stocks. In fact, I think those are some of the best kind of companies that you can own. Because a dividend comes out of the company's free cash flow, the only way that company can afford to pay and grow its dividend is if its free cash flow is also growing. And for the free cash flow to grow over long periods of time, the business also has to grow its sales and its net income. And to me, those characteristics should be non-negotiables when you're looking for potential investments. Why would you want to invest in a company that is consistently losing customers over time or shrinking its profits over time? I don't think you would. Plus, a company's share price ultimately follows its financial growth. So if it's consistently growing sales, growing its earnings, and growing its free cash flow, which once again leads to dividend growth, the share price will eventually follow. Otherwise, if the share price stayed flat over the years while the dividend just kept increasing and increasing, the dividend yield would shoot up, which would then cause investors to pile in for that higher dividend yield. And that new demand alone would push the share price up anyway. And with all of that said, I actually think you could make the argument that a company's share price over time follows its dividend growth over time. But anyway, at the end of the day, yes, you can absolutely build a successful portfolio without investing in high yield stocks. And now guys, moving on to question number 3. This one comes from Joella. And Joe wants to know, is SCHD plus SCHG all I need for ETFs? Should I add a VOO as well? Or is there too much overlap? This is another great question. And honestly, good on you for even thinking about overlap when it comes to ETFs. A lot of investors don't. And it causes them to invest in multiple ETFs that are actually pretty identical. I call it double dipping. Now, to answer your question, I think the best place to start is to look and see how much overlap there actually is between VOO, which is the Vanguard S&P 500 ETF, and SCHG, which is the Schwab US Large Cap Growth ETF. Since both of these funds tilt pretty heavily toward large cap growth, this is where we're most likely to find any real overlap. Now, using the ETF overlap tool over here on Snapstock, which you can start using for all of your stock research and analysis, there's a link to Snapstock in the description of the video. I hope you check that out. But we can see that in total, there's about 58% overlap between VOO and SCHG, which does beg the question, is that too much overlap? Almost 60%. Is it worth it or not to own both? And to be honest, it's kind of hard to say. SCHG in total holds 197 stocks, and over here we can see that 116 of those are also in VOO, which means that you still get exposure to 81 companies that VOO doesn't have. Now, at the same time, since VOO has a total of 507 holdings, it gives you exposure to another 391 companies that are not in SCHG. Now, based on that, I think you could definitely make the argument that there's enough diversification between these funds to have both of them in your portfolio. But even without VOO, I mean, SCHG still has 197 holdings. SCHD still has 103. So even with just those two funds, I mean, you're not lacking on diversification as it is. You'll be fine either way. Anyway, guys, now moving on to question number 4. This one comes from CX289, who wants to know, I'm paying off debt at the moment and wondering if I should be investing simultaneously. It's funny, I actually get this question a lot, and the answer honestly kind of depends on what kind of debt you have. If we're talking something like mortgage debt, I wouldn't wait to invest until that's paid off, because that can take decades, and you don't want to miss out on years of compounding just because you're trying to be debt-free first. On the other hand, if you're dealing with high interest debt, especially something like credit card debt that has interest rates sitting usually between 20 and 30%, I think you'd feel a lot better wiping that out first. And once that's gone, you'd find yourself with a lot more available cash to invest every month, and also less financial stress hanging over your head. I think you'll just feel better without having that debt. Now, with that said, there's absolutely nothing wrong with doing both at the same time. I actually do see some merit in that approach, and I actually do like that approach because it gets you in the habit of starting to invest regularly, which really is half the battle for a lot of people. Even if it's a small amount, it's going to get you in the routine of setting aside money consistently in your portfolio. The only downside to that is that it will take you longer to pay off your debt, which means you'll end up paying more in interest than if you dedicated all of your spare cash to chipping away at that debt. And at the end of the day, there really isn't a right or a wrong answer here, but personally speaking, I am a fan of knocking out that high interest debt. You don't want that hanging over your head. And I think, if you were to pay that off, you'd feel a lot better without that weighing you down. But anyway, guys, now moving on to question number 5. This one comes from Law, and Law wants to know, should you set your mind on small dividend income goals or a big one, short-term goals versus long-term goals? And to be honest, I think both are important to have. The ultimate long-term goal for any dividend investor, or really any investor, is financial freedom, where your dividend income covers all of your expenses. I'm sure every single one of us daydreams about that every day. I know I do. And that long-term goal is easy to define, just reaching financial freedom, but it is worth spending some time thinking about what that actually looks like for you. In other words, how much dividend income would you need to generate every month on average to live entirely off your investments? And the hard part about it is that reaching that point will likely take multiple decades, depending on how aggressively you're investing, of course, but it's going to take a long, long time. So because of that, it's going to be hard to get a good grasp on how much you'll really need, so far down the road, which is totally understandable. But still, you can always come up with some sort of ballpark number and then adjust that as needed. That's going to be your North Star, and that's ultimately what you're working toward. In the meantime, while you're following that North Star, you will hit plenty of smaller milestones in your portfolio, and I think that's one of the great things about dividend investing, this long long and tedious journey is full of small victories that keep you motivated along the way. And I highly encourage you to take a moment and celebrate every single one of them. Your first $1,000 in projected income, your first $100 month, your first $200 month, your biggest day of dividend income ever. All of these things are definitely worth celebrating because they're reminders that you're on the right path, that what you're doing is working. And personally, the next big goal I'm aiming for is $4,800 of projected annual dividend income, which breaks down to $400 per month on average. I'm hoping I can hit that sometime in 2026. But before I hit that one, there are some other smaller goals that I'm working toward along the way, like reaching $4,000 of projected annual income. I'm like right on the brink of that. And also, reaching my first $400 month of dividends, which I'll actually hit here in December. But anyway, all of that is to say you should absolutely set both short-term and long-term goals. And it's funny because when I first started investing, I really didn't have any of this stuff mapped out. I had no goals. I had no plan. I had no sense of direction with what I was doing with my investments. I just had a feeling that something in my financial life needed to change. And if you want to see what that looked like, then check out this next video right over here. In this one, I'm walking you through what I wish I would have done differently from day one and how I would approach things differently now if I had to go back and start investing again all over from scratch. So click right over here to learn all about that, and I'll see you in the next one.